Welcome back, Real P&L traders. In this video, I'm going to talk about margin, specifically portfolio margin and span margin as it relates to selling option premium. And I'm going to cover two distinct advantages of using span and portfolio margin. And the first I call early management high return optimization. Then I'm going to show a little known tactic called profit stacking, and how I use it to earn an extra 4% per year in my trading account in conjunction with portfolio margin and or span margin. It also has a limited use if you're just using regular margin. Whether you're a seasoned pro or just starting with options trading, understanding these concepts could be crucial to your trading strategy. So let's demystify these terms together. The margin basics, what is margin? So margin alone from your broker, it allows you to leverage larger positions than your capital permits. And it's a key tool in a trader's arsenal. So what is regular margin or Reg T margin? Regular margin is margin used where you leverage 2 to 1. So for example, if you have $1,000 and the stock is trading at $100 per share, you can buy 10 shares and spend that $1,000. But if you use regular margin, instead of having the ability to buy 10 shares, you have the ability to buy 20 shares, with that same $1,000. You're basically leveraged 2 to 1. So that's regular margin. Also, regular margin's based on, when you talk about options and trading options, it has to do with the expiration line, and I'll get into the details further on in this video about that. So what is portfolio margin? It's a more advanced method that looks at the entire risk of the portfolio, considering how different positions interact with each other. So what's span margin? So this was developed by the Chicago Mercantile Exchange, CME, and span margin is a system used worldwide, particularly in a derivatives market, and evaluates overall portfolio risk for futures and options on futures, as opposed to portfolio margin, where it's mainly, a lot of it's based in the US. Now, I also use span and portfolio margin pretty much interchangeably. The thing about span is you got to use it on futures or futures options, and portfolio margin, you could use it on equities. So I use span margin basically to lower the amount of capital used to get returns. So what's the difference? Span margin is easier to get. It only takes $1,500 in your account. It's used for futures again, and it has stricter guidelines with the T+0. I'll get into that more when I look at when I show you the risk graph, but it's plus or minus 15%, where the portfolio margin, you have to have a minimum of 125,000. This is with Thinkorswim, and with Interactive Brokers, it's $100,000, and it can be utilized for a wider range of assets, of course. The guidelines are a little better, a little less strict. The T+0 are minus 12, plus 10, and minus 20 divided by 2. And I'll get into the details about that, but how to kind of determine kind of a guideline of how to determine what your margin requirements are when you put on a position. So two reasons to use PM or span margin. Advantage number one, early management, high return optimization. And advantage number two, profit stacking. So I'm going to get into both of those. So advantage number one, early management, high return optimization. Let me get into that now. First of all, when I was talking about the margin requirement, a general guideline that I use is when you're looking at, for example, portfolio margin, if you have a trade structure on, this is like a broken wing butterfly with a long put at the end. It's not like a great thing to trade, it's got bad theta, whatever, but I'm using it as an example. What I would do is go up 10% and see what my requirement is here. Like, how much is my P&L at that point? Right there, it's minus $2,208. And then I would go down 12% and see where it is, or where that T+0 is the lowest point between the actual price and then, 12%. Where is it lowest? It's probably about right here, about $2,700. So here it was around 2,100. Here's around 2,700. That's the lowest that T+0 went. And then I'll take the 20. You can take the 20%, and you divide it by 2. But the 20% here is not a problem at all. But if it was a negative number, you could divide it by 2. Whichever number here is the lowest, which happens to be, out of those 3 points, $2,700. So that's going to be your margin for portfolio margin, right? Now, if I was using span margin, I use a little bit different metrics. I go up about 15% and see where the lowest point is. Here it's around $2,200. And then I go as high as 15% and look at the lowest point. And that's, again, it's the same here because the lowest point here with both of the margins is around $2,800. So that's how you, kind of a guideline on how to predict what your margin would be if you put on a trade structure with options, what your margin would be, just a ballpark guideline, and how those are used. Now, let's take this example and let's talk about early management high return optimization. So what does that mean? What it means is that I'm actually, like, for example, if this was my trade structure that I was using, if I get out of this trade early meaning before it expires, right? This is your expiration line. So this is where you're going to be at expiration based on the price. So this one right here has, if you look at the expiration line and you go over here, it has about $22,000 worth of margin. Okay. But if you look at the margin for portfolio or span margin, it's only about $2,700. Okay. So looking at that, let's say your numbers are around 21,500 with regular margin and about 2,800 with span or portfolio margin. Okay. So that's what I just showed you. So how is that a big deal? Like, how would you use that? Well, early management, high return optimization. So the fact that I'm going to get out early or could get out early, I'm able to leverage that point. And so let's say that my profit target was $1,000. Well, if I was using 21,500 in capital, I would only get about a 4.6% return. But if I'm only using $2,800 and making $1,000, I can get a 35% return on my money. So you can see how if you use this early management concept or portfolio or span margin, you can get a higher return. You can optimize your percent return on your capital being used. So that's what I mean by taking advantage of portfolio and span margin in terms of return on capital. But also I need to point out that your risk is actually the same, whether you're using $21,500 in capital or whether you're using $2,800 in capital, you still have the same risk. It's just that when you use portfolio or span margin, the fact that you can get out of the trade earlier lowers your capital requirement, but doesn't lower your risk or change your risk. The risk is still there. There's still the same amount of risk in that trade. Now, number 2, let's talk about profit stacking. This is the second item. Essentially, it's like double dipping. So where you have an options trade on and you also have another asset that's making money for you. And it's kind of like free money. And it's basically double dipping. I'll get into that. So here's how to use profit stacking. So with profit stacking, for example, you can see here I have a spreadsheet. Let's say that so each treasuries have very little buying power used up, and then stocks use a little more buying power. But for example, if you do have a treasury that's less than 1 year in duration, it uses only 1% of your buying power. So for example, if you have $100,000 in your account and you buy $100,000 worth of treasury bonds, it only uses $1,000 in buying power. That means you have $99,000 left over to trade options with. So in essence, you have $199,000 that you are trading with. $99,000 you're trading with options and $100,000 you're trading it with bonds. So you've got bonds, if they return 4%, that's a 4% return for, in essence, almost nothing. I mean, it's just an extra 4%. That's profit stacking, okay? And depending on which bond you want to buy, depends on how much margin you'll be using here. Now, you can do this also with regular margin. These bonds make your regular margin more efficient. You can get another 4% return on regular margin account. Now, when it comes to stocks, it's a little bit different. You've got the margin, regular margin, you get 50%. So if you have $100,000 in the account, you can actually spend $200,000 on stocks, right? If you, so you're at 50%, but with portfolio and span margin, you can profit stack with stocks. You can buy like Apple stock, and you only margin 15% on that. So you still have 85% to spend. So you're in essence spending $185,000 that you can use to trade with. And same for span and portfolio, both the same. So in essence, instead of buying bonds, bonds use a lot less buying power, but even stocks only use approximately 15% of your buying power. And you've got $100,000 worth of stock, and then you got $85,000 left over to trade options with. Okay, so that's profit stacking, double dipping. It's an important concept. I've increased my returns by about 4 to 5% this year just from profit stacking. It didn't cost me anything. It didn't take away from any of my buying power to do what I normally do. Well, I did it with bonds, so it really didn't, in short term. So it really didn't take away from my buying power. If you do it with stocks, it takes a little bit away from your buying power, but not overly significant. Now, just a quick recap on early management, high return optimization, and profit stacking. Can you do this with, for example, portfolio margin? Yes, you can do both. With span margin, yes, you can do both of those. Now, with regular margin, you don't have the advantage of early management, high return optimization, but you can do profit stacking on treasuries. And then also with stocks, you can't really do it as well. You're about 50% instead of 15%. So there's some limitations with regular margin. So the results, let me show you some of the results in my account, how I was able to take advantage of profit stacking. Now, I think you might already know that I've been able to take care of the, advantage number one there by using portfolio and span margin. So for example, in my account where I only trade the Premier Level 5, you can see how much I've made this year with just buying bonds, like extra money. So 500, 870, 11, almost $1,200 that I've made on a, $35,000 account. It didn't cost me anything. I profit stacked. And you can see here where I profit stacked with one of my other accounts where I was trading normal, didn't change anything that I was doing. I just bought some bonds on the side and made, what is that, 8, 9, over $10,000 just by profit stacking, just using money that was already just sitting there, not doing anything. Profit stacking could become very important to you because you can increase your return significantly without using up any buying power or hardly any buying power at all. You don't change the way you're trading, but yet you're getting more of a return. So what are the risks when you're profit stacking and using margin in general? Obviously, when you leverage up, you're going to take on more risk, right? So the best way to combat that is to make sure that your sizing is done correctly. If your sizing is not done correctly, your margin can expand with margin, portfolio margin or span margin. It can increase. With regular margin, it doesn't increase. It's just set, and that's where it is once you put on the trade. But with portfolio and span margin, it could expand and increase, and you can get margin called. So you have to make sure you know what you're doing, and you have to size things properly. You've got to back test to make sure that everything's back tested and sized properly before you go out and use leverage. I have done that already with the Premier Level 5 strategy. The Premier Level 5 is my flagship non-directional strategy for making money in all markets and keeping drawdowns low. If you learn this system, it'll help you, keep the sizing situation in check, because if you're using portfolio and span margin, it can get dangerous. So you want to make sure that you got your sizing in check. And that's what the Premier Level 5 already does. I talk about sizing and how to size. And if you're interested in learning more about the Premier Level 5, I've included a link in the description for that. As always, leave a comment if you have any questions, and I'll see you in the next video.